Hello and welcome to Chapter 2 of Options for Value Investors. My name is Fizzbuzz and today we're going to be talking about intrinsic versus extrinsic, particularly value. We're going to talk about what is value, what is intrinsic value, and what is extrinsic value. So first, let's talk about value. Value can be thought of as the amount that someone is willing to pay for some kind of asset. So for example, this house has a value, which is how much it could be sold for from one person to another. The intrinsic value of this house is what the market would pay for the house right now. Whereas the extrinsic value of this house is everything else. So you may be thinking that the house has no extrinsic value. However, an intrinsic value of the house, we're talking about things like how many bedrooms and bathrooms it has, location, the fact that it has a nice yard, and we may come to a total value for the market price of this house. However, people live in a house and there's slightly more to it. So the extrinsic value of this house may include things like an emotional attachment, or the amount of hassle that moving involves. Therefore, you may add those two together to take the amount that someone would actually want in order to sell the house to someone else. So in this case, even though the house is only worth 1 million, the person living in the house may want more than 1 million in order to actually go through with the sale. So what does this mean when we're talking about stocks and options? Well, in an options contract, you have intrinsic and extrinsic value, just like that house. We can think of the extrinsic value as two things. First of all, we can think of it as time. The amount of time left in the contract has a level of value, and we'll go over what that means later. We can also think of the extrinsic value as risk. And that's not something we're going to discuss too much in this chapter, but it will definitely come up later in this series. So let's focus on the time value, which we'll continue to refer to as extrinsic value, but you can insert the words time and or risk if that helps you understand it better. So let's talk about intrinsic and extrinsic value in options. Now we're going to start looking at the value of a contract at the time of expiration. So if the contract has an expiration of December 1st, then we're looking at the value of that contract after the market has closed on December 1st. So starting off just as a baseline, if we have 100 stock, and in this case the stock is currently priced at $55. If we have 100 stocks, then we have 100 times $55, and the total value of that is $5,500. There is no extrinsic value in that. There's no value in that beyond the intrinsic. So similarly, a $50 call contract, remembering that calls allow you to buy a stock for a particular price. In this case, we could calculate the intrinsic value as the difference between the stock price and the strike price. So that would be $5, and everything in options is times by 100. So that would be $500 total intrinsic value for the call contract. And at the time of expiration, a contract has no extrinsic value. You'll see that all the way through this table. Extrinsic value being the value of time and risk. There is no time and risk left in a contract at the point of expiration. So a $50 call contract with $55 stock price, the value of that is $500. Similarly, with a $60 put contract, remembering that this allows you to sell a stock at the strike price. So in this case, we could sell 100 of the stock for $5 more than the market price, which would be a profit of $5 per stock. Again, $500 total for the contract. Now, if we look at a $50 put contract, this would allow you to sell stock at $50. Now, if we are able to sell our stock at the market price of $55, there's really no reason for us to use that contract, and therefore it is now worthless at the point of expiration. Now, this is fairly simple, but obviously most of the time we're not looking at contracts at the point of expiration, we're looking at them sometime before expiration. So this is not any specific numbers, it's just a way that we might be able to understand this. So we're going to look at these numbers again, but in this case it's before expiration. Don't worry about how long before, let's say it could be a week or two before expiration. And so at this point the stock price is still $55, and we have the same 4 instruments that we're going to look at. So we're going to look at the 100 common stock first, and again this has $100 shares times $55, $5,500 total value, and shares never have extrinsic value because there's no time or risk component to them. So the value of these shares is still $5,500. Now the call contract has an intrinsic value of $500 and an extrinsic value of $100 because it has some amount of time left and some amount of risk left. So if someone was able to buy the contract for less than $500 in this current scenario, they would be able to immediately exercise the contract and make a profit. So that's not something, you're not going to sell this contract for less than $500. However, you might sell it for $600, which would allow you to keep your intrinsic value and make an extra $100, which might mean if the stock moves up quickly in the future, you might miss out on that. So that $100 is paying for the time that the purchaser may be able to make additional profit. And obviously if you're buying this contract, you think the stock will go up and you're thinking you're going to make significantly more than the $600 that you're paying. And likewise with the $60 per contract, you're thinking the stock will go down more than it currently has, so you might pay $600 for something that's currently worth only $500. Now the $50 put contract has no current intrinsic value because the stock price is currently above $50. So someone selling that contract would probably still want to collect a bit of money for it, depending on how much they estimate the risk of the stock going down that much. So they might collect, say, $50 in order to sell you that contract, and you might want to pay $50 if you think that in the future this contract will have intrinsic value, which means that the stock price would be below $50 at expiration. So you're paying here for a potential future intrinsic value. Now let's run through those one more time. This time the stock price is at $60. So the common stock are now worth $6,000, an extra $5 over the previous example, but they still have no extrinsic value. And this is at the time of expiration. Now the $50 call contract now has an extra $5 worth of value, and again that just doubles the profit for that particular contract up to $1,000 from the previous $500. The $60 put contract, which remember allows you to sell the stock at $60, is worthless because the market would also allow you to sell the stock at $60, so there's no reason to use that contract. And the $50 put contract is way out of the money, and so although it is just as worthless as the $60 contract, it can be thought of as even more worthless. Now before expiration things are slightly different. Obviously the common stock, as with all these examples, is worth exactly what it's worth, but the $50 call contract is now significantly in the money. So the intrinsic value of that call contract is $1,000. The extrinsic value may be a little bit more than before, just because the intrinsic value of the contract and the extrinsic value are correlated, along with time and risk and many other things that we'll go into later. That $60 put contract would call this at the money because the stock is $60 and the contract is for $60. Now there's no intrinsic value on that $60 put contract. However, there's a much higher likelihood that that will be in the money or profitable in the future compared to the $50 put contract. So we would expect to pay quite a bit more for that at the money contract than the out of the money contract at $50. So as a rule of thumb, if you have an in the money contract, which would be something that is currently, if it's a call, it would be something that's under the current strike price, and if it's a put, something that's over the current strike price, then you will contain both intrinsic and extrinsic value as long as there is some time left in the contract. Now, out of the money contracts, which are the opposite, will contain only extrinsic value. There's no intrinsic value to a put that is out of the money or a call that is out of the money. At the money contracts, which would be ones that are very close to the current strike price, actually have the highest extrinsic value. This is important to remember in the future. So, just in case you are a slightly more visual learner, these charts will show you the extrinsic and intrinsic value for those same scenarios. So, as we can see, the calls have more intrinsic value the further away from the stock price your contract is for, and the puts will have is on the opposite side. So let's say the smallest bar there is for $51 call contract. Now, if we look at these again before expiration, we can see that we have not only intrinsic but also extrinsic value in these contracts. And the two bars closest to the stock price you see have the most extrinsic value. And that's simply because there's the most risk and time and interest in those contracts, because people will be having strong opinions about which way a stock is going to go, and they'll be prepared to pay it to get an instrument that will allow them to profit from their particular thesis or bias. So why does any of this matter? I mean, why is this chapter 2 in a series about options? Very intentionally, I want to talk about this very early in this course because it is a key concept that many options traders do not understand. So understanding intrinsic versus extrinsic value will not only give you a leg up on other options traders, it will also allow you to avoid some costly mistakes. One example may be that people, when they look at options, particularly put contracts, they think that they can sell in the money contracts and make significantly more than selling out of the money contract. As we've seen, if you are selling intrinsic value, it is unlikely that you are going to make significant moves on that value in a contract. As opposed to that, if we look at extrinsic value decays over time, and the closer you get to the expiration, that decay actually accelerates. So in this example, you may have $180 worth of extrinsic value at 90 days, which may drop down to around $150 after 60 days, and then quickly accelerates down to $90 after 30 days to go, and then from $90 it will go to zero at the 0 days mark, remembering that contracts have no extrinsic value at expiration. Again, why does this matter? Well, that chart might look scary if you are buying contracts, but if you're selling it, it's great, because if you're selling a contract to someone, you want the value of that contract to go down so that you can either buy it back for a profit in the future, or you can hold it to expiration, and if it has $0 value at expiration, then you have collected your premium from that contract and you have profited. So appreciate this is quite an abstract chapter. You may need to watch it a few times in order to fully grasp it, maybe once you've looked at some of the later chapters. So I do encourage you to come back and revisit this concept once you've learned more about the options selling process that we're going to go into in future chapters. But for now, thank you for listening, and I have been Fizzbuzz.